Hello and welcome to this interesting webinar on positioning India in the global portfolio of NRI investors. Friends, despite India being one of the fastest growing economies in the world, investment by NRI investors account for just 4% of the total mutual fund assets as on March 2026. While there is no official data on their contribution to alternative investment funds, industry experts believe that NRI represent a significant untapped business opportunities for advisors and MFDs. Wealth managers say that many NRIs are currently more inclined towards developed market, particularly the US. Themes such as artificial intelligence, data centers have attracted considerable investor interest. However, despite this trend, India's growth story remains firmly intact. India continues to be one of the world's fastest growing major economies and is well positioned to sustain growth in the years ahead. So, how can financial advisors and mutual fund distributors position India as an attractive component of an NRI investor's global portfolio? To discuss this, we are delighted to welcome Vishal Gorradia, Managing Partner and Fund Manager at Aikyam India Discovery Fund. He brings over 19 years of experience in financial services with expertise in managing multi-asset portfolio. Vishal holds an executive MBA from ISB and is a chartered alternative investment analyst CAIA. So without wasting time, let me welcome Vishal. Vishal, welcome to the show.
Thanks a lot, Nishant. Pleasure to be part of this webinar. Thank you very much.
Great, great, great. So Vishal, so we are holding this webinar at a very interesting time. So at a time when many Indians are looking overseas for global diversification, you are encouraging NRIs to invest in India. What gives you such strong conviction in India's story?
Sure. So I think so. First is when we look at NRIs by naturally because they're staying abroad, they're generating income abroad. They have a lot of assets which are in non-INR in local currency, as well as they have a decent allocation in terms of the global diversification for global equities. But when you compare with Indians who are investing abroad, they are starting with a relatively very low base, and so it's still a different theme for them. Having said that, global diversification across asset classes, across region is something which I also strongly believe in, and every NRI also should do it. But when we look at the global diversification or the global equity space, over the last couple of years, what we've seen is the market which have rallied really hard are, let's say, Korea, Taiwan, Japan, US, and LATAM. And underneath them, what we see is one large theme which has been emerging, which is the AI infra spend, right? The AI capex. And we had recently done an analysis as well just to understand that in each of these markets, when you look at the last 2 years earning growth and the forecasted 2 year earning growth as well, what we see is that predominantly four large sectors which has been performing really well. One is definitely the technology, second is industrial, third
Hmm,
is energy, and fourth comes the financial services. So
hmm,
all of them are still part of the same value chain. So though we might say that we are well diversified across different regions, but at the end of the day, what is there is a concentrated bet on one particular theme. Because if it was very diversified, then even in these regions would have found the earnings to be across sectors, across themes. And what we've seen in last 1 month, because it's so concentrated, it's also equally fragile, right? So we saw in early July when Meta announced that it might basically lease out its excess spare AI compute. We saw Korea basically correcting close to 30% from its highs, and then even since yesterday we saw a sell-off across the AI theme because of the fear that China is now getting into the entire chip manufacturing machine space, and so this is also what it means is a very concentrated bet. Now,
hmm,
if you compare that with India, India had its peak in 2024 September. Since then, 2 years index has moved sideways, but in the same period, 2 years of earnings has been baked in, valuation
hmm,
has been reset. Government has taken multiple steps in terms of reviving the consumption. plus your public capex is still on track, private capex is inching up. And more importantly, looking at from an international investor perspective, the currency is also depreciated a lot, right? So it's over the last 1 year, we must have depreciated close to around 10-11%. So
Mm.
the fear of a further depreciation is also going to be contained, and it gives a good entry point that if the index now moves up, then there could be a potential upside from equity. So my whole point from a diversification is that is it adequately invested from an international investors? At this point of time, India's risk reward is much better than looking at an AI trade related risk reward. And let's say 2 years ago, definitely when India was at a peak, at that point of time, investing abroad was definitely making more sense. But right now, the risk reward has flipped. And so, having more exposure to India, I think so, in my opinion, is much more rewarding. And just give one last data point on this. Let's say if we were just looking at the returns of all these economies, Korea back in September 24, the 10-year returns were 3%. And as of date, the last 10 years for Korea is now 18%. So we can simply see that the return which we have seen is only over the last 2 to 3 years, and this was not before that. So yeah, that's why I'm very bullish from an India perspective where we are currently.
Yes, yes. In fact, today I've read in a newspaper that one of the Chinese semiconductor company, which listed has increased by 450%, right? So that shows the valuation is very steep in these sectors. Yeah.
Perfect. Perfect.
So, Vishal, my next question is about Indian markets. So, Indian markets are currently facing several headwinds. So, you have seen that foreign institutional investors have been pulling out, US interest rates remain elevated, and geopolitical tensions have prompted many global investors to shift back to developed markets. Why do you think that this is happening, and what lies ahead for Indian equity markets from here?
Sure. So I think so. Everything started maybe somewhere around 2023 when the economy started to slow down. So the all the early high frequency data, if you had start seeing in 2023, it had shown the signs of a slowdown. We
Hmm.
also saw the earnings also starting to slow down by end of 2023 and early 2024, though the index peaked in September 2024. Since then, one was definitely the economy slowing down. Second, when Trump became the president, the entire trade war tariff started, plus which led to rupee depreciation. And now finally we had an oil shock also, which had a significant impact on our economy, and
Hmm.
that has continuously led the outflows from FII standpoint. But I think so. If you look a bit more nuanced in the flows, there are two, three trends also emerging, and which would be important to note. One is that what we've seen is between the 2012 2019 era, when a lot of PE money, VC money came to fund these startups, right? A lot of these companies have IPO'd between 20 end of 2023 till 2025, right? And that flows going back has also led to the net FDI going down.
Hmm.
Second, when you look at the FPI flows in detail, what we see is also it is being concentrated on financials and tech because that is what they have accumulated for the longest period. But in the same time, you see that though they're selling in the secondary market, but in the primary market they have been net buyers across all the months. Then you will also see a lot of buying happening in industrials, metals, which is the manufacturing. So they are also repositioning their portfolio. And finally, when we look at from an FI standpoint, is that now when we look at the India as part of the MSCI index, it has significantly gone lower. Like it was 20% in 2024, now it is close to 10%. So let's say even
Hmm.
a marginal pullback when they become neutral, a lot of flows will be coming back. And so even on the first point of the FDI flows going back, it's also a huge POC, right? Because it's a proof of concept that in India, you can get into a startup and eventually see an exit and take the money back as well. So the
Hmm.
next round of PVC money, it will be much larger as well and with much more confidence as well, right? And what we started to see since sometime last year is basically a lot of new funds is now moving towards the manufacturing, whereas all the earlier 2010s fund were more towards tech and consumption. So that shift is also happening. And coming to what lies ahead, in my opinion, if you'll see the earnings in Q4 only had seen a significant jump. What we see is basically Q1, Q2 of last year, which was June and September of 2025, was the lowest point in terms of the earnings. The earnings recovery is back.
Mm.
All the even after the war, over the last 3 to 4 months, when we look at all the high frequency consumer discretionary numbers as well, they've been holding up well. Be it
Mm.
even the PMI numbers. So the macroeconomic indicators are also not showing any kind of a slowdown. Yes, definitely because of the oil spike and the Iran war, the growth might have got derailed by let's say a quarter or two, but we are strongly there in terms of the recovery, and we should see a breakout soon, hopefully.
Vishal, my next question is that many NRIs are currently investing through FCNR deposits. In fact, India has received nearly 17 USD billion dollar through FCNR deposits so far, and the government is targeting USD 50 billion dollar by the end of September. So, with returns translating to around 14% in rupee terms, why do you think NRI should still consider taking equity risk?
Sure. I think so. Over the last 1 month, I think so. This is the highest question which I've addressed from everyone. Most of the investors has just been comparing between FCNR deposit
Mm.
and equity. So how I look at it is very simple. Basically, that the ideal comparison is the 6 to 7% FCNR rate compared to equity returns, because what we are looking at, a 14% is all a levered play. So it's a fixed income carry trade.
Mm.
And now, ideally, from an allocation perspective, how I look at this basically that this should be under the bucket of a fixed income allocation. So let's say if an NRI is holding, let's say, on an average a 70-30 ratio between equity and fixed income. So ideally, this is a good opportunity. Basis that if his or her investment is generating, let's say, 7 to 8% dollar return elsewhere, that money should be moved towards this particular, because this is a time bound investment opportunity. It definitely has various hurdles, right from getting the leverage, be the taxation element which the US investors and European investors are facing, and also certain central banks like UAE who has been pushing their banks to not provide aggressive leverage, because they also fear that a lot of money will be flowing out of their system. But keeping that aside, it's a good trade definitely, but it should be considered as a levered fixed income play.
Mm.
Why not consider and compare it against equity? Because that's a growth capital. Now, when you enter into this trade, though it might be a 14% trade for the next 3 years, but you know the total upside beyond which you won't be able to generate out of this capital. On the contrary, if let's say we are able to achieve the 50 to 60 billion dollars of target, it should be taken and looked into in a much more positive manner, that this is going to support the rupee, and then eventually populate into the economy, be more stable, and then eventually revive the sentiment for India, and might also lead to FPIs and FIs coming back to the country. So this should be more growth positive, more equity positive. Now, if I have to look back, and the next obvious question is going to be that Indian equity returns have gone nowhere over the last 2 years, then why we should? But if you look over the last 15, 16 years, we've seen such episodes where we've seen 2 to 3 years of consolidation, and then we've seen a significant re-rating happening. So let's say when you go back to 2011 to 13 period, we were part of the fragile five, we had the twin deficit issue. During this 3 year period, the returns was absolutely flat. But when you look from 14 to 17, it is 20% CAGR. Now, and this is all rupee depreciation adjusted dollar returns, which I'm talking about. Then again, 18-19, we had a consolidation phase. I think that the index would have given not more than 3 odd percent. 20, it was 18% after the fall of COVID. 21 to 24, again a 20% CAGR. So again, maybe by end of September till now, we are in this consolidation. It's already been 21 months. And hopefully sometime this year, we will be breaking out. And then we might see a much higher returns for the next 3 years, right? So then what is happening is you've been locked in your money at a 14% or a 12% return, and you're missing out on the growth capital. So in my head, we should be looking at it into two different bucket and then allocate growth capital differently and a fixed income capital differently.
Got it, got it. So, Vishal, should India be viewed as a strategic allocation or a tactical allocation in an NRI's portfolio? And how important is currency risk when NRIs invest in India?
Sure. So I'll take the currency question first because that's closer to my heart as well. So currency, in my opinion, if we are investing anywhere globally, ideally it should, in my head, is always a currency hedge product because you are investing for an equity exposure and you should be looking only from that perspective. Um, to be candid, when we launched our own fund, we had completely designed as a hedge product and we were going to launch a hedge product. But when we reached out to various investors, wealth advisors, distributors, we got a pushback saying that this is a drag onto their returns and they are much more comfortable taking that risk. And eventually, we had to launch a unhedged product. But in hindsight, now we look at it. If we had, I think so this was one of our misses from our fund. It would have the return would have been far more superior if we had come out with a hedge product. So I would definitely suggest that till the time India structurally is into a current account deficit, we
Mm,
are going to have a depreciation bias. We will definitely have years of maybe a stable depreciation and maybe something like episode which we've seen over the last 12 months. But if it's going to be a depreciation bias, it makes sense to pay that hedging cost and also get that peace of mind that in case anything goes significantly wrong, at least from currency perspective, you are not impacted. So I would definitely recommend a hedged investment across anywhere, be it India or elsewhere. On the first point, sorry, I missed. I forgot the
strategic or tactical?
Sure. So it has to be strategic from my perspective. I think so. The math itself tells you the story. So let's see if you look last 30 years and you break it into three prominent eras. So first is let's say 2000 to 2008. We had
Mm,
the entire globalization boom. The money was flowing out of US into EMs. Commodities were rallying. All emerging markets were rallying. Now, at that point of time, if you look the returns, how was the return profile like? You had India, which in that period gave a CAGR of 25% dollar return. Korea was 23%. China was around 17, 18 odd percent. And Taiwan was around 8, 10%. And US was 2%. Now,
mm,
the highest relative growth was happening in EMs, and that's why the returns were being accordingly. Now, when you move to the post GFC till let's say 2024, from '08 to 24, when the entire world was in a lot of crisis, right? You had the early 2010s, you had Europe, which was in a crisis mode, which peaks crisis. You had China in the middle of the decade was into the real estate issue. India had its own set of issues, right? From we being part of fragile file, then we had the NPA banking cleanup, then we had an ILFS issue. So the relative growth was happening only in US. US on the bank on the back of easier monetary policy, the entire tech stocks which were driving the rally. Between these period, if you look at the returns, US tops the chart with 11%. India comes second
mm.
at 8%.
Yes.
Korea, China, Japan, all were in low single digit, anywhere between 3 to 4%, right? So the whole idea is that over the last 25 years, India has either been the highest generating dollar return or maybe within the top three. And we at AIKM also strongly believe that we've again turned the cycle where the higher relative growth will be coming out of EMs, and it can't be without India participating into it. For the next 10 years as well, India is projected to have a high real GDP growth that will all translate into higher earnings, right? And this is the perfect time when your currency is also at all-time low. So definitely India has to be from a strategic standpoint as well a higher allocation in the EM space. So yeah.
Okay. But Vishal, what key tax considerations should NRIs keep in mind while investing their money in Indian financial products?
Sure. So one other way to move is thinking from a product perspective to switch towards, let's say, a jurisdiction plus structuring perspective. So, and which is how most of the sophisticated investors from family offices, also family offices, ultra HNIs or institutions look at that if they have to take an access to a particular economy or a particular sector region, what is the best way to do it? Now, simply put, direct equities, whichever route you enter India, you'll have to pay the normal LTCG, STCG taxation. One level of complexity higher would be, let's say, coming to the investing via the mutual fund space, via the NRE, NRO account. In that, you also have to look up is there any double DTA benefits which has been signed between India and your local residing country. If yes, to claim that benefit, you need to file the TRC every year and claim the benefit. Here, Gift City also comes into play where, as a destination, they have, as a jurisdiction, they have completely exempted any taxation on income generated from derivatives, units of mutual funds, and ETFs. So here, that's one particular jurisdiction come like if you're coming via Gift City, you get that tax advantage. But having said that, if you're coming from a jurisdiction such as US, which has a higher taxation, then it's not that lucrative because irrespective, even if you pay zero tax in India, eventually you have to pay tax in US. But someone coming from, let's say, GCC or in Singapore or Hong Kong, Gift City route opens up a tax-free route for them instead of coming via NRE, NRO route or let's say direct equities. And tax saving is also a significant component. Let's say even if you're talking about a long-term taxation of 12.5%, over a 20% return, a 12.5% will come to around what close to 2.5 odd percent. So that's a big amount, and when you compound it over time, it adds up to a larger amount as well. So those consideration is what NRI should be keeping in mind.
Great, great, great. So, Vishal, which sectors or investment themes in India are you most optimistic about over the next 3 to 5 year period?
Sure. So I'll anyways mention those which we are already overweight in our fund. And so one particular theme which we are bullish on is the entire BFSI space. So banking balance sheet are the cleanest in last decade. The credit growth has been started to pick up, and more importantly, any significant growth in the economy won't be happening without banking participation in it. And currently, all the banks, irrespective be it private or public, they are having the healthiest balance sheet. They can support a significant growth. The NPA levels are significantly low. And not only the banks, even the non-banking NBFC, the wealth management. So that entire piece is very exciting from a valuation standpoint. Also, the entire banking space is either trading at the mean or a bit of a discount. So it's a good entry point. The second particular theme which we are bullish on is basically the manufacturing plus exports. So why we are referring to exports is basically over the last 1 year, the depreciation has also opened up additional avenue with FTAs getting signed and implemented. Hopefully, the European FTA will be enacted by early 2027. And this will lead to a significant push. There's already been a push on the manufacturing, China plus one, reshuffling of the entire supply chain, which all should be beneficiary, and especially with the government's focus on manufacturing push, right? So that's one theme which we are excited. Just to give you one stat, if you look at the last 3 months auto export numbers, and it was phenomenal. So it was around 15,000 units which has been exported out of India, and this number last Q1 FY26 was only 1100. So there has been close to around 10x jump in the export. So that's something which we are also closely keeping a tap on. And finally, I think so. What other themes which we are bullish on is also power, which we feel is a decadal theme. And yeah, so broadly, a few sectors which we themes and sectors which we are currently bullish on and overweight on.
And what's your view on tech?
Tech, so since the beginning of our fund, we have made sure that we have been underweight on tech. What I also personally feel that we are currently in a phase where the entire industry will take its own time to find its new mode of operation, right? Because as of now, yes, there's a lot of pressure in terms of with the innovations happening on the AI front. Because we are eventually nothing but outsourcing and we are supplying cheap labor. So that model will undergo its own reinvention and maybe hopefully in the second phase of AI growth, once we move ahead from the capex infra and the build out phase, is then when we move to the application phase. And that time Indian IT should be participating. So currently we are in near future we might see a bounce back on the back of any deterioration or any negative news coming from AI spend or any impact on that theme would have a positive impact. But still, from a long-term perspective, we need to see that how the entire model gets revamped and is that sustainable? Because right now, the biggest question which everybody is asking is what's the terminal value? What's the longevity of this business value? Will we be able to price the revenues for the next 25 to 30 years, right? And that's currently a question mark which people are still grappling to get an answer for. So yeah, at the moment, if you look at the free cash flows, etc., it's doing phenomenal. But when you look at the quarterly earnings, also their new order wins are also not keeping up to the pace. So it will still take some time to for the model to be completely evolved.
Okay. So, Vishal, one interesting question that I wanted to ask you is that which investment vehicle is most suitable for NRIs today? Mutual fund, PMS, AIF, gift city funds, or direct equities? And how should they choose among these options?
Sure. So I would definitely lean more towards a structured, professional managed investment route, which could be MFs, AIF, or PMS. Not because I'm sitting on this side of table, but simply looking at the evolution also. Like going back to let's say 1990 when we had limited stocks, it was easy to track and easy to invest, etc. Then, as the number of stocks increased, we had the entire mutual funds coming up. And cut to today, we are having close to around 50 AMCs with 10 new AMCs getting approval in last 7 to 8 months. Plus, we have the SIF as a category, plus the entire 1700 AIFs, maybe hundreds of PMS. There's a lot to choose from, right? And so another segment which is coming up is basically kind of a fund of fund, which what they do is they take away. So FOF does predominantly two things. It takes three key decisions: where to invest, when to invest, and which PMs to select for. So that's another interesting vehicle which is coming up, and which with the growing complexity of tracking so many stocks, so many themes, so many funds, so many PMs. I think so. This will take away that pain from the investor and hand it over to a professionally manager who would be also selecting the PMs who would be best suitable to basically execute their view. Now, it could be into any particular segment of the market, but that's one more interesting avenue or the structure which investors can look at. But apart from that, depending on the requirements. So let's say if the idea is to get into a long only kind of a fund, if the idea is to be invested towards, let's say, this large and a mid cap, then mutual fund definitely is best suited. If the idea is to get more micro cap kind of an exposure, then the emerging AIs is a better instrument. And a mix of all is, I think, so FOF also is a stronger proposition for investors to look at.
Okay. So, Vishal, before we move on, I would like to request all our audience to post their questions on Q&A box so that we can simultaneously take some questions. So, Vishal, my next question is about Aikyam India Discovery Fund. So, how it is
Sure.
different from other India-focused investment funds available to NRIs today?
Sure. Sure. So yeah, Aikyam India Discovery Fund is a macro top-down India equity fund. What we do is we don't, so our entire bandwidth does not go into selecting stocks. Our entire bandwidth is going into identifying that which particular sector or theme will be performing better. And then once that allocation is being decided upon, the second is the decision is basically like which PM should we give the money to, who would be best suitable for managing or managing that particular few of hours. And so, yes, it's a fund of fund. It is investing across active and passive funds within India. The benchmark is Nifty 500, so it's kind of a flexi cap approach, but it's very dynamic in nature. So it will keep changing the allocation and the positioning of the fund depending on the outlook for the market. So if let's say, for example, and just to cite you an example, since the launch of a fund, we were not very comfortable on the overall market because we were when we started the fund, the index was around near 26,000. So we were not very comfortable on the valuation. So let's say close to around up till 9 months, we managed a very conservative portfolio. We were heavy large cap. We were holding on an average cash of around 8 to 10%. We were playing defensive. Just before the war, we had further raised the cash. And during the Iran war, when the index also had gone down, corrected decent to around 22,500 levels, is when we completely switched our portfolio to an aggressive positioning. We made the portfolio SMID heavy. We took a lot of sectorial themes in the portfolio, including defense, including metal, including infra, auto, and this all have played out extremely well over the next, like from let's say from March up till now. And so this is how the fund is also managing. It's an actively managed portfolio. But the biggest advantage is that because of its structure in Gift City, it gives the tax advantage. It's 100% tax-free product for the investors, especially for investors who are coming from GCC or Asia, where there is zero capital gain tax. For those set of investors, this will be 100% tax-free investment. And the benefit also stands that they don't need to track multiple funds in India. They don't need to worry about the positioning which they need to manage for the equity market. All these things will be managed by AIDF. So that's the broader summary of what the fund is and how we manage it, basically.
Okay, but how many underlying funds does the portfolio hold? And how do you decide the allocation across funds and investment strategies?
Sure. So currently also, so the average holding of funds will be around closer to around 14 or 15 funds. And the thought process is very simple. So the allocation framework is 75% of the funds would be towards market cap funds and 25% would be towards themes or sectors or factor funds. Now, within the market cap space, we select three active funds within each category. So three funds for large cap, mid cap, small cap. So that comes to 9 funds. We do keep at least one passive fund or an ETF within the each bucket because it gives us the flexibility to position a portfolio, change the positioning of a portfolio without paying any exit load on any of the investments. And then, so that brings the holding to around 9 to 11 or 12 funds. And then we have the thematic bets, which on an average are around 4 or 5. And so in the end, it's a portfolio of around 14, 15 funds. Yeah. So that's the holding. And in terms of the allocation, basically so what we do is we have a very structured way of looking at different pockets of the market, be it market caps or be it sectors, and we look at from four different lens. So first lens which we look at is a pure fundamental. So for each of these sectors, let's say we do track various KPIs to understand the underlying trend in the sector. Is there any theme which will lead to a significant growth or a stagnation or maybe a slowdown? Then we look at the financial, do an entire financial analysis. Then we are moving on to the looking from the valuation lens. That how is the overall sector, the key entities, the key companies of that sector from a valuation standpoint. We also do because it's eventually a top-down fund. we do a thorough tracking of the high frequency indicators to understand what's the macroeconomic activity, is it aligned towards which particular sector, and how will it impact various different sectors or market cap. And the finally is that the entire quantitative side of analysis. We look at various information like what is the flows like, what is the momentum in various themes or various pockets of the market, do a lot of ratio analysis, and eventually all these is converted into a scoring model basis different market cap and sectors. And then basis the rating is when we decide on the allocation as well towards different pocket of the market or different sectors of the market.
Okay. How does the onboarding process through Gift City differ from investing in a regular mutual fund in India? And what
Uh,
support does AKM provide to distributors for onboarding clients?
Sure. So I'll just compare it within other funds in Gift City because the domestic onboarding would be completely different. So from compared to other funds in Gift City, we are completely aligned. As of now, in Gift City, the regulator requires a phygital kind of an approach, which is we need to hold the KYC documents, the agreements in physical in our office. So how we approach is a very light approach. We only look for one proof of address, one proof of identity, FATCA, CRS, and the agreement. We don't ask for PAN, we don't ask for Aadhaar, and then we eventually what we have a dedicated onboarding team who will support the investor as well as or the wealth manager in getting those documents couriered to us. We also have an on the ground presence in Dubai, Mauritius, and Singapore, which works very closely with our wealth advisors or the investors and make sure that any kind of documentation required is being either basically if there's a OVD required, originally verified document, that also has been arranged for, and we get the documents couriered also. But the more important part is, and the good news is also that the regulator IFCA has already this year has already released a lot of circulars for the digital onboarding. We currently are in process of discussing with couple of vendors, and hopefully in the next couple of months, we target that we'll make it 100% digital process, and that should literally cut short the entire onboarding time from let's say 3 to 4 days to let's say within a day we'll be able to finish it. So it'll be much more smoother.
So, Vishal, talking about Gift City again, so how do you see Gift City based investment products evolving in the next few years?
So Gift City is already it's already a thriving ecosystem. As of now, as well, if you look at there are currently 220 odd fund management entities, and cumulatively they are managing close to around 40 billion of committed capital. So fund management is one ecosystem which is been growing. Talking purely from a regulator standpoint, I think so. IFCA has been a great supporting regulator for us. In general, to the entire ecosystem, they constantly engage with all the participants. They constantly take feedback and keep coming up with more and more regulation, which is ideally for a pro business perspective. And purely looking at from a regulation perspective, it is relatively a bit more open compared to domestic India, and therefore a lot more innovation in terms of product or strategy should be coming out of Gift City. And from a longer term horizon, also, I'm pretty sure that it's going to be a larger gateway for capital coming into India. A lot of local asset managers have already started shifting their offshore presence from various international jurisdictions to GIFT. So definitely a lot more funds, a lot more structures is what something which we all anticipate will be coming out of GIFT.
Vishal, one last question. What milestone would you like the AKM India Discovery Fund to achieve over its first 3 year period?
Sure. So broadly, I think so. What we've also internally said is basically so currently this is our first fund, and from an AUM perspective, they're sitting at around closer to $10 million. And what we anticipate is by the end of third year, this clubbed together with the other funds should be in the range of around 200 to 250 million dollars. We are in process of launching two more funds. We are already working on an outbound, which is going to be a multi-asset fund, which hopefully should be live by end of this calendar year. And we are also simultaneously working on a domestic fund for pre-IPO. So we want to eventually also have a suite of fund offering. So that's one milestone which we want to achieve. And secondly, from an AUM perspective, is what we're looking at. And finally, and the most important one is when we look at the performance. And we are not an absolute return fund. So what we also envisage is a consistent outperformance or an excess return generation of 3 to 4% for our investors. I think so that would be a significant milestone for us.
So, all right, Vishal, we have come to an end to this interesting discussion. Thank you so much for your valuable time and inputs. You have answered all the questions very comprehensively, and you have given a
Sure,
lot of insights and food for thought to our audience today.
sure, sure.
And finally, I thank each one of you for being such a wonderful audience, friends. Have a lovely day at work, guys. Thank you.
Thank you.
Thank you, Vishal.
Thanks a lot, Nishan. Pleasure,
Pleasure
pleasure.
talking.
Yeah, same here. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.